Guarantee insurance, also known as a surety bond, is a type of insurance that protects the injured party, obligee, from financial loss if the insured, principal, fails to fulfill his obligations under the contract. Bail bond insurance can be a valuable tool for investors and companies. For investors, this can provide peace of mind knowing that they will be repaid if the bond issuer defaults. For companies, this can help them get loans at lower interest rates and increase their chances of winning contracts. These obligations can be anything, but usually include 1. Complete construction projects on time and within budget. 2. Provide materials or services according to the contract. 3. Paying debts. 4. Comply with government regulations. If the principal fails to fulfill its obligations, the surety company will pay compensation to the obligee up to the amount stated in the surety bond. There are three main types of surety bonds. 1. Bid bond, used to guarantee that the principal will submit a genuine and competitive bid for a project. 2. Performance bond, used to guarantee that the principal will complete the project according to the contract. 3. Payment bond, used to guarantee that the principal will pay all subcontractors and suppliers working on the project. Surety bonds are often required in situations where there is a high risk that the principal may fail to fulfill its obligations. This includes large construction projects, government contracts, and complex financial transactions. The cost of a surety bond varies depending on a number of factors, including the risks involved, the amount of collateral required, and the term of the bond. Here are some of the benefits of warranty insurance. 1. Provides financial protection to the obligee. If the principal fails to fulfill his obligations, a surety bond will ensure that the obligee does not suffer financial losses. 2. Helps the principal get a job. A surety bond can help the principal get a job by showing the obligee that they have the financial ability to complete the project. 3. Streamline the procurement process. Surety bonds can streamline the procurement process by allowing the obligee to evaluate offers from principals more objectively. The following are some of the advantages and disadvantages of guarantee insurance. 1. Cost. Surety bonds can be expensive, especially for high-risk projects. 2. Underwriting requirements. Surety companies may have strict underwriting requirements, which can make it difficult for the principal to obtain the bond. 3. Claims process. The claims process for a surety bond can be complicated and time-consuming. 4. Overall, surety insurance can be a valuable tool to protect obligees from financial loss. However, it is important to understand the costs and drawbacks of a surety bond before deciding to use one. Surety bond insurance is a type of insurance that protects bondholders from default by the issuer. It is essentially an insurance policy taken out by a bond issuer to ensure that interest and principal payments will be made to bondholders, even if the issuer experiences financial difficulties. Here are some of the benefits of bail bond insurance. 1. Provides security to investors. Surety bond insurance helps protect investors from default by the issuer. This can make bonds more attractive to investors, which can lead to lower interest rates for companies. 2. Helps companies get loans. Surety bond insurance can help companies get loans at lower interest rates. This is because the insurance company essentially guarantees the loan, which makes the lender feel more secure. 3. Increase the company's chances of winning the contract. Surety bond insurance can help companies win contracts by showing project owners that they are financially sound and capable of completing the project. Overall, surety bond insurance can be a valuable tool for investors and companies. However, it is important to consider the costs and benefits before deciding whether to use bail bond insurance.